Mr. President, who do you want to see running the Fed?
Well, as you know, I've been seeing a number of people, and most people are saying it's down to two, Mr. Taylor, Mr. Powell. I also met with Janet Yellen, who I like a lot. I really like her a lot. So I have three people that I'm looking at, and there are a couple of others. I'd say I will make my decision very shortly, pretty shortly.
That was President Trump telling our own Maria Bartiromo in her exclusive one-on-one interview with the president that he plans to make his choice for the next Federal Reserve chair very shortly. We're taking a look at futures this morning. There is no blip in the market's move up. The Dow, S&P, and NASDAQ closing at all-time highs. On Friday, the Dow, of course, earlier in the week, crossing that 23,000 mark for the very first time. Joining us now is managing partner at Oxbow Advisors, Ted Oakley. Ted, I wonder if the market is not pricing in any potential change at the top of the Federal Reserve, given what the Fed is in the process of just beginning in terms of tightening monetary policy.
You know, Dagan, it could be. I think what happens is it won't make a lot of difference which one of these come in. You know, you have one Fed governor and another economic professor, which has been standard fare for this group for the last 25 years. So I don't see that making a lot of change in the long run.
Well, the fact that you say that and the market seems to be feeling that way, because one person that President Trump didn't mention was Kevin Warsh, but the Wall Street Journal wrote on Friday in an editorial that Kevin Warsh or John Taylor, who teaches at Stanford, would be a change agents at the Federal Reserve. Jay Powell to a lesser extent. So if you have somebody come in and the market doesn't really know how they might handle this tightening of monetary policy, this reduction in the balance sheet, that's an awful lot of uncertainty for investors.
It is, but one of the things that happens is you have a Fed that's really not in tune, and they haven't been in tune with Main Street. So what happens, they raise the rates on the short end. Obviously, they've been doing that. But if you look at the 25, 30-year paper, it's basically still the same. Actually, it's lower for the year. So the market's doing one thing, and the Fed thinks they can control it, but they really can't.
There's been also, Scott, I'll just point out, there has been a backup in the 10-year yield, which closed on Friday at 2.38%. And that's not even close to the high for this year so far, which was north of 2.5. But still, you've seen, as the markets rallied, you've seen a move up in the 10-year yield.
Which is the reaction you want to see, because typically if stocks rise, interest rates should go up. And Ted, to your point about the long-term interest rate curve, I mean, what does that tell you, considering that, as Dagan said, you know, we are on this hiking path that the Fed is now on. What does that tell you, though, about the behavior of long-term rates with respect to economic growth going forward, Ted?
Well, it tells me that growth won't be what they expect it will be. If you look at what's been going on this year, if you look at consumer prices, PCE, everything, we're just not getting the move that they thought they would get. And in the long run, what that means is that their growth numbers probably won't be what this group expects. I think they're putting a lot of emphasis on tax reform, that sort of thing, but it doesn't look like to us it will pan out as well as they think it will.
Robert?
Yeah. Are you concerned that if tax reform or tax cuts, as the president referred to it over the weekend with Maria, is delayed at all, that would have a stinging effect on the marketplace, since you're less concerned with the Fed?
I am that. I think people have resisted selling and doing some other things because they thought, well, maybe there'll be a lower capital gains rate. Maybe my rate will be going down. I'm not quite as worried about it as I was. But then, and they look at it, and you look at it this way, you know, 65% probably of the jobs in this country come from individual businesses. And I'm not certain he's doing enough in that. I mean, if you give the corporations a lot more money, that's great, but they're not spending what they have now. So I'm not certain it'll create what they expect, and it probably could have a negative impact on the market because the average payer looks at it and says, I'm paying too much already.
Caitlin, just in terms of the market, the one thing I would raise is the president has spent a lot of time on Twitter and verbally crowing about the record stock market. And the more he talks about it and tries to take credit for it, well, then he's going to own any decline, whether it's mild, whether it's short, a short run or a long-term decline in the market.
Yeah, exactly. Has been taking credit for the past several months, really.
And more, it seems like more so, like
every day.
Yeah.
Right. And this is a White House that needs this good news, right? Because they don't have legislative accomplishments yet in Congress. And so pointing to things like this are helpful. I mean, Republicans want him to continue talking about this, but you're right. You have to take the blame for when there's a downturn.
Well, I will see what happens on Friday. We get the GDP for the most recent quarter for the and again, the economy was growing at north of 3% for the second quarter. The first reading on the third quarter is expected to come in at 2.7%. So if it's worse than expected, see if the president takes credit for that. Ted, thank you for being here. Ted Oakley joining us this morning.